And howdy, everyone. Welcome to Tilson Live. It is Tuesday. We are here live on Facebook, live on YouTube. I am Eric Allerid, Senior Vice President, Tilson Homes, part of the fourth generation of the Tilson family, joined as I am every single week, thank goodness, the ever-capable, ever-talented, award-winning, Marketing of the Year finalist, Dawn Dantzler, our Director of Marketing. Say hello, Dawn.
Hi, everybody.
All right, so folks, y'all drop in the chat where you are watching from, where you're building. We'll be live on Facebook and on YouTube. That helps us out with knowing where we're coming in from. So we're great to see everybody. And we have a very special guest this week. We are joined for the first time on Tilson Live by a world-class mortgage loan officer. He's way more than that, though. He's been doing this since, I think we were doing this before we both had children. Were we not, Matt?
Yes, sure. That is true.
Yeah, we have quite literally grown up doing this together. So we have Matt Howe from AmCap Mortgage. We're so grateful that you're here, Matt. Thanks for joining us. And Don, I know we got people jumping in, seeing where people are watching from. So Matt has been working. Tell us a little about yourself, Matt, how you got into the mortgage world, how long you've been working on loans, and specifically on your land, partnered up with Tilson. What's going on?
Yeah. Well, I'm happy to be here, guys. Thanks for having me. Just a little bit about myself. I've been a preferred lender for Tilson. I'm on my 16th year now, specific to a build on your lot transaction, and more so specific to how Tilson does their transactions. So I started with TXL Mortgage, and that group transferred over to AmCap. That's AmCap Home Loans now, actually. We were transferred over to AmCap about 2014. Since 2014, we've been with AmCap Group. So we've been there for the last 16 years. You know, the mortgage landscape has changed quite a bit over the years, but the way that Tilson has kind of set up their transaction has stayed consistent and has been a saving to the consumers, because they don't have the two-time close, they have the one closing at the end. In the Easy Buy program, it's definitely been a benefit to the consumers. And some lenders kind of have a hard time kind of wrapping their head around how they operate and what they're needing actually prior to construction beginning to get things rolling.
Sure. Mm-hmm. Sure. Yeah, we're going to talk about that for sure today, because we are we're a bit of an odd duck in that we build out of our own back pocket. So most custom builders, in fact, really no other custom builders do that. And so we're going to speak about that today. But yeah, I mean, Matt's been doing this, guys, for a decade and a half, working directly with Tilson and our customers, has closed thousands of loans, and also does, not just Tilson loans. He'll do other refinances and things like that as well.
We're just his favorite.
Of course.
That's right. By far.
He has a wildly capable team that he's assembled and surrounded himself with that they do a great job of taking care of our customers. So we really appreciate you, Matt, and your team for what y'all do for all of our customers, because it can be a stressful thing, right? I mean, they've got this land, and it's a very personal, deeply emotional experience, and it's nerve-wracking, right? Because as we were talking about before the show started, you can have the perfect home design, have everything just the way the buyer wants it, and they've got the kids' rooms all set up, and even how it's going to sit on their land, they've got that all planned out. Until you can kind of bridge that financial gap of how are we going to pay for this thing, none of the other stuff really matters very much.
Mm-hmm. Absolutely. And we have, like you had mentioned, you touched on, I have a team behind me that has a lot of experience in this type of transaction as well. So I'm the branch manager of the account. So I'm still originating loans, but I have Victoria Sanchez and Taylor Crowell, who are also loan officers on the account that have a lot of experience behind us doing this. In addition to that, we have very talented assistants that work with us as well, that do a lot of the behind the scenes with our borrowers, doing a lot of the back and forth, that are really well versed in this type of transaction.
Great.
And guys, I know you got his information up here that Don's assembled. Obviously, drop your questions in the chat. So you're doing that already. Yeah. We'll be answering all your questions. We have some teed up, but you saw that on that NMLS number. So here's a mind-blowing thing for you folks out there. Matt, prior to 2007, what was that number? Was it even a thing? Was there any such?
I don't even remember it. Yeah, prior to that. Yeah,
there was nothing. So here's the deal.
Yeah.
There was no licensing for loan officers prior to 2007.
Oh, wow.
Let that sink in. Like, Trek didn't have any kind of licensing, nothing. What happened? What was it in 2007? I wonder that caused. I'm trying to remember what that was. But folks, seriously, you're dealing with someone when you get with Matt Howe and his team. You want somebody that's walking you through this process who's didn't just start last week or last month or last year. It's been a crazy year, been a crazy 2 years, and that's great and wonderful. And there's been some interesting stuff that's happened. But Matt and his team, they were here in the Great Recession. Like, they watched the climb through 04, 05, 06, and then they watched everything change. Everything changed.
Absolutely.
He was around for the subprime stuff. He knows what that looks, smell, and feels like. He'll keep you out of situations like that. So there's a lot of knowledge here. Dealing with somebody that didn't just start doing this when the market got hot. So anyway,
absolutely.
Into plugging for that. Don, we got people from all over the place. Where are they from?
We do. We have Chris coming in from Fort Worth.
Cool. Very cool.
We have Rosemary's building in Cape
Karankawa. I'll help you. Cape Karankawa.
Yep, would have gotten that one wrong. We have Renee from Salado. Marilyn's coming in from Blvd County.
Awesome, Marilyn. Thanks for watching.
And Chris is building in Palo Pinto County.
Awesome. I think Marilyn just went on contract this weekend, I believe.
Oh, awesome. Brandy's coming in from Leon County.
Awesome.
We got Brandon from Klondike.
What's up, Brandon? Thanks for watching.
Someone coming in from Round Rock. We got Kenneth coming in from Maypearl.
All right.
And then we got Chase, who says how much he likes dealing with Matt.
Oh, little
hey, Chase.
Run out early in the show. Look at that.
Yeah, that's pretty awesome. And then we have some questions. Rosemary is asking, what is the average interest rate right now? She's in the process of closing and is wondering what hers will be. So, Matt, if you could just pull up Rosemary's file. I'm just kidding.
No. Well, I mean, there's several factors that, that go into your rate and what's going to be available to you. I would say, for an A+ borrower on a conventional 30-year fixed rate program right now, and when I say A+, I'm saying 740 plus on your credit rating.
Okay.
And assuming, of course, you have 10 to 20% equity somewhere in that range, you're still going to be below 3% as of today.
Wow.
Oh, wow.
Today is, let the record reflect, this is September 7th, 2021. For those of you watching on the internet in like 2030 or something like that, you dig this video up as some kind of YouTube time capsule. It was a real thing. Like, you're reading in the history books, it was below 3%.
Yeah, so people are taking advantage of those lower rates. There are some refinances going on still, but yeah, I mean, right now rates are extremely low. We don't know what they're going to be 10, 12 months from now. Can't forecast that far ahead, but I know. But if you were locking in today, A+ borrower, we should be able to get you, below 3, if not 3, right below 3.
Wow, that's amazing.
Yeah. So, of course, like I mentioned, the programs and your credit qualifying, background, things like that are going to factor into that, whether it's conventional, FHA, VA loan. Those all obviously different products are going to have different rates, but on a conventional loan, that's what I was talking about.
Awesome. Okay. Yeah.
And then Eric, we
also different programs that y'all offer here in a second.
Yeah. Absolutely. Another question from YouTube: have we built a home that appraised for less than the price to build?
We have.
Yeah. So appraisals are a funny thing. They're very subjective, to be honest with you. From one appraiser, for example, one appraiser can complete the appraisal on your property, and another appraiser can have a different opinion of that value. Just based off of the comparable sales that they might use, what area that they're coming from, the area of the comps that they pull from, can dictate that value. So the short answer is yes, it has happened before where the appraisal comes in lower than anticipated. And in those cases, the customers are going to have to come out of pocket with some down payment.
Yeah. And we do encounter that, of course, on our side, and particularly because we build, and Matt's experience with this, 91% of what we're building is in an unincorporated area of a county somewhere. Only 9% of our customers are building inside of a municipality. So the further you get out, to Matt's point, the further away those comps or comparable sales, homes that are similar to yours that have closed in the last, is it 6 months, Matt? Have it closed in the last
6 to 12 months. You can go up to 12 months. But yeah, typically they're going to be within that 6 month range or so.
Okay. And so as you might imagine, it starts to kind of thin the herd out a little bit when you say it's this far away, it has to close in the last 6 to 12 months, it needs to be of the same quality, or it can't be a mobile home or a manufactured home, it has to be another house on slab. And so all those things play into what that appraisal might end up looking like, and the appraisal doesn't really have a whole lot to do with what the house cost to build. In fact, there's really no correlation.
Right.
They do a cost approach, but that's not the one y'all use, right? Y'all use the comparable sales approach. And so it's based on what other stuff around you has sold for. It's as simple as that. It's what is the fair market value. And again, like Matt said, according to this individual who is licensed, like to appraise, you can't just hire anybody. It has to be a Trek licensed appraiser. But yeah, the values can vary, and we do build because for most of our customers, it's where they want to be.
Right.
Physically, this is where they want their forever home. And I'm not advocating we want to make a bad investment, but I think over time, over the next 15 to 20 years, you're probably going to be okay building a home on an acre or two in Texas. Like, I don't think it's going to go down in value. I think you're pretty safe.
Right, absolutely. And because since you're building in more remote areas, as you mentioned, Eric, that those comparable sales may be 15, 20, 25 miles away from your property. That's sometimes how far the appraiser has to go just to find something that's, even, in the same realm of your property or the house that you're building. When building out in country, that's not uncommon to get comparable sales that are that far away, just out of necessity. That's how far they have to go. So as you can imagine, in some markets, we're not going to be lining up exactly where you think it should appraise because of that. But the land values are still high, out in those rural areas, which is helpful. But we still need to look at what home sales are going for in the area to determine that value.
Yeah. And folks, this is why it's really, really critical that you deal with someone like Matt, who not only, he's in Texas, like he's sitting in an office in Houston as we speak. He's not in Minnesota or Pennsylvania or Bangladesh. Like, he's here. And he can lend anywhere in Texas. Right? Everywhere that we operate, you can play ball. And so you're not, when you start trying to talk to somebody, not disparaging Pennsylvania, Minnesota, I'm sure there's great people there. But when you start trying to get a hold of somebody there and talk to them about the comparable sales in Fairfield, Texas, unincorporated Freestone County, like, good luck with that, off of private road 14.
Unincorporated? What does that mean? What's a farm to market road?
Yeah.
So it's critically important you deal with somebody that's fluent in that and can talk to the appraiser, talk to the underwriters, and you're not just my kind of rule of thumb is if they have a 5-digit extension that you have to dial, probably not somebody you need to be working with. You're probably not very important to them.
Well, I give out my direct line, so you can call me direct.
Well, if you didn't, you did now, because we just put it on there a little while ago. Anyway, that's great. Easy to get a hold of. Okay, so what else? What other questions do we have, Don? What's going on over there on the interwebs?
Well, we've got Wesley joining us from Arizona, building in Greenville.
Awesome.
We've got Stephanie from Huntsville.
Hey, Stephanie, thanks for joining.
And we've got from Humble. Just started working with Matt. He's amazing.
Man.
Oh, thank you.
That's a praise for Matt. And then we've got the Thompsons from San Antonio, building in Spring Branch.
Beautiful area.
Let's see. Other questions that we have. We had one that came up prior to us going live. Somebody asked us to make sure that we answered how would an unexpected retirement affect their final mortgage process?
That was my question. I planned to retire.
That was not your question.
Well, so in general, when income changes between your approval for construction and our permanent closing at the end, that does happen from time to time, whether you retired, maybe you got let go and had to find a different job or something of that nature. We're just going to have to recalculate your income based off of, in this example, based off of what your gross monthly retirement is as compared to what you're making with employment. So as a loan originator, for all different programs that we have, there's always a maximum debt to income ratio that we need to qualify you for. So a conventional loan has a certain benchmark, a VA loan has a certain benchmark, an FHA loan has their own benchmark. And when it comes to your monthly income, we would just need to determine, is this retirement income enough to still support this mortgage approval? If not, then we can look at other scenarios, paying a debt off, looking at bringing in maybe possibly a non-occupying co-borrower or co-signer, something to help you out in the end, if that retirement income does not end up being enough to support the approval as it was for your employment income. So sometimes we have a customer up front that says, hey, Matt, I'm working now. I know I'm going to retire in 6 months. So when I'm closing, my income is going to be looking different than it is right now. In that case, I need to know what your monthly retirement income is going to be, so I can inform Tilson, that, hey, I'm approving this guy off of his retirement income that he's not yet receiving, but I can't approve him off of his employment income because we know he's not going to have that for our permanent approval. So if that's communicated up front and we know that income is going from X to Y, we're going to make sure we qualify off of that Y, because we want to know what it's going to be for our permanent loan closing rather than what it is right now. So if those are already plans that are in place that you're going to be making maybe an employment change, or you're going to be retiring, or maybe you're applying jointly and one of you is going to be retiring, one of you is going to continue to work, we just need that communication from our borrowers, so then we can advise them on what they need to do going forward. So things happen sometimes. Life happens. So there are some instances where we'll have you approved, based off of a certain credit profile, employment history. And then when we go to update your file for the permanent closing, either there was something that occurred during construction where you fell behind on some bills and now your credit went down. Part of what myself and my team can do is to counsel you on the credit, so we can help you with your credit, get back up to, where you want to be or closer to where you were even, based off of some tools that we have available to us. We can let you know paying down on credit or paying off a particular account may boost your scores where you need to be. And we can do that for you also prior to construction beginning, just to get approval with construction. And we can do it on the back end to get you a better rate, things like that we can do for you. Just not to get off on a tangent, but if you are, we got you approved for construction, we've issued our approval letter to you and to Tilson, and they've broken ground, Tilson's broken ground, we're under construction, and you get let go from your job for whatever reason. We just ask that you communicate with us, and say, hey, Matt, I got a situation here. I got let go. Where do we stand with our mortgage approval now? What we can do for you in that case is say, listen, I understand what you're going through, but here's the monthly income that you're going to need minimum to maintain this approval, because you may have been making a large sum of money monthly at your previous employer, and that's going to decrease most likely when you're starting up with somebody new. But we can advise you on kind of what your minimum benchmark has to be to maintain the approval so we can close your mortgage at the end. Or we could advise you on, again, paying off a debt, maybe changing loan programs, because other programs have higher debt to income thresholds than the one that you may have been approved for. So there's a lot of moving parts, when it comes to this type of transaction. It's a long process on a build on your lot. So it's not going to be you're not going to get approved for the loan and then close in 30 days. It's not that type of deal. This is going to be a year-long process. Yep. From beginning to end at minimum, just depending on kind of.
So you've got some runway if something happens. which is nice.
Yeah.
So
you have an exit ramp. It's not a brick wall that you're up against.
Yeah, absolutely.
And in general, I would say if we run into trouble on the back end, and correct me if I'm wrong, Eric, but Tilson is not in the business of foreclosing on people. That's not what they want to do. And
that's correct.
As long as you are working with the lender on a result, getting them the result to close the loan, and you're actively communicating, and we have a game plan put together for you, Tilson's not going to take your property from you. They're not going to foreclose on you. That's the very, very last resort. And that's if you as a consumer basically say, hey, I'm done. I'm not going to work on this approval anymore. I can't do it.
Right.
Then
it's so rare that happens. Yeah, that it's. I mean, I can't even. I could count on both hands and feet in my career the number of times that has happened, and it's usually something pretty catastrophic, actually. And so it's. Texas,
I get that question a lot.
Oh yeah, well, everybody wants to. We all make these stories up in our head. They're never a good story, right? I mean, it's. I have a weird tingling in my neck. I'm gonna go to WebMD and see what's wrong with that. Well,
it's a tumor.
You got 6 weeks to live now.
Spoiler alert! It's a tumor.
Yeah.
So anyway, he's Matt's right. I mean, we want you in this home. That's the end game here. With the last thing we want to do is have to go sell the house again. It's hard enough selling it the first time. I mean, it's
right.
So, anyway, but I know we got a bunch of other questions.
We do.
If we need to clear you if that's your question, great. If we need to clear something up, let us know, and we'll do that.
Yeah. Tanya is asking, can you pay for the PMI premium up front? And if so, does that increase the interest rates available on a 30-year mortgage with a 15% loan to value?
Which probably means an 85% loan to value.
Yeah, 85%. You can do an upfront. You can pay the premium upfront. I'd honestly have to price it in. I don't want to speak out of turn for that if that's going to affect your rate. We haven't done one of those in a long time where people pay the lump sum premium up front. Typically just finance it.
I didn't know that was a thing.
Yeah.
I'm glad I watched Tilson live today because I learned something. It's so important that we watch.
Yes, you can pay a lump sum premium, but I would have to, double check that and see if that would affect the rate. So I'm sorry, I don't have that answer right now, but
cool.
That is an option.
Thanks, Tom.
All right.
Thanks for asking.
And then we have Clint asking, I have my current home refied with a VA loan and we plan to keep the house after we build our next home. Could I use a VA loan with the Tilson program or would I have to use a conventional loan?
So it depends on how much entitlement you have left. So you can, in some cases, have 2 VA loans at one time. But depending on how much entitlement was used for your current VA mortgage would dictate if you have enough entitlement left for a second VA mortgage. We could qualify you on a second VA mortgage, but you might have to come up with some more down payment, if you have some entitlement there. But if the bulk of it was used up on that first transaction, you may have to look at a conventional program or an FHA. But you can, in some cases, have 2 VA loans. Just depends on your entitlement.
Matt, how does because you got the funding fees associated with VA, like, is it, I know, and I'm only asking because I know some VA people will be like, if they don't use the VA loan, they're missing out on something. But right now, given where conventional rates are, is there a real disadvantage to going conventional versus VA?
There's not. I mean, there's a misconception out there that if you're a veteran, VA is the best program for you. And that's not always the case. Especially if you're in a convention, if you have 20% equity, that opens up some options on a conventional loan for you where you don't have any PMI. And if you're not a fan of escrowing your property taxes and insurance, you have that option on a conventional loan with 20% equity. You do not have that option on a VA loan.
You're VA, no matter what.
You have to escrow your property taxes and insurance. Doesn't matter how much money you're putting down. That's a requirement. There's also a funding fee on a VA loan. So it depends on how many times you've used your VA eligibility will determine that factor or the percentage of funding fee that's rolled in. Also, how much equity you have. Yeah. So if it's your first time using it, your percentage, the funding fee is lower. But if it's a subsequent use, there's a higher percentage of funding fee that's rolled in. You could possibly be exempt from the funding fee if you receive VA disability, which is definitely a benefit to you and something we look at when we're trying to compare apples to apples between a VA loan and a conventional loan for a borrower. We're going to factor all those things in. So what's the funding fee going to be for this veteran? Are they exempt? How much equity do we think they're going to have? Will that open up an opportunity for a conventional loan? the difference between the rates right now is very negligible. I mean, it really depends on, your qualifying credit score and things like that. So if you're an A+ borrower and you have 20% equity, a conventional option may be a better route for you than a VA loan, especially if you have a funding fee.
I wouldn't immediately dismiss conventional just because you are a veteran, which thank you for your service, obviously, but you may have other options out there that financially, like Matt's saying, big picture, you may have a better shot. So it's great.
Yeah. In the VA loan, one of the benefits to a VA loan is they have a higher, we talked about this monthly debt to income ratio. You can have some more debt on a VA loan and qualify, whereas you couldn't on a conventional loan. So conventional is more so what they call A paper. So they're going to want lower debt to income ratios. They're going to want some equity, and they're going to want a higher credit rating borrower. Whereas on a VA loan, you may not have that 740 plus 700 score. Maybe you're a 650 borrower or something like that as far as your credit rating goes. You have a high debt to income ratio, but you're a veteran. Then we can qualify you on a VA loan where we wouldn't be able to qualify you on a conventional. So that's part of the benefits to being a qualified veteran as well.
Yeah, because it is truly an entitlement. Yeah, you're entitled to it.
Okay.
What else we got, Ms. Dawn?
Sam is asking, he is already retired, so his income is whatever he takes out of our IRAs. How is that analyzed and considered into his income?
Sure. So when you're taking a distribution of an IRA or a 401k account, we have to look at a couple things. One of the biggest things is at time of closing, not at time of construction approval, but at time of closing, whatever monthly distribution that you're taking, we need to document that you have at least 3 years continuance of that income.
Okay.
So we have to, document via your IRA statement or your 401k statement that at time of closing, you're taking, X amount per month from that account, and you can continue to do that for at least 3 years from our closing date. So we have to show a cushion there, some reserves in that particular account. One of the nice things about taking a distribution, if that's your primary source of income, is we can adjust that. So if at time of construction approval, say you're taking a $4,000 distribution, monthly from that account, but we really need you to be taking $5,000 for our debt to income ratio. Prior to closing, you can adjust that upwards, prior to closing and show that you're taking a higher distribution, and then we can get you approval for the mortgage. So there's some flexibility when you're taking distributions such as that. Whereas if you have a retirement plan and you're getting, say TRS, your teacher retirement system, then we know what your retirement's going to be, and you can't adjust that. That it is what it is,
it's fixed.
And we can't move that up or down. But we do have some flexibility on a distribution or an IRA account, something like that.
Okay, that makes sense.
Thanks, Sam. Thanks for asking.
Amanda is giving compliments to Taylor.
It's competition now.
Taylor's amazing. She's awesome. Yep. So she's been with us for a long time, and has got a lot of knowledge.
Awesome. And then we have a question: how does the loan process change when you build a home that is less than full turnkey? So I guess, Matt, this question is really like, what is required in order to close on a mortgage?
So, we can't close technically as a lender. I can't close on my permanent loan until the house is 100% completed. Okay, so we're not going to be able to close until that house is done. So we're going to go through, for this type of transaction, we're going to go through a full underwriting process twice. Okay, so we'll do a pre-qualification, and a pre-qualification typically consists of a credit pool. We're going to look at your monthly debt to income ratio based off of what you submit to us as your gross monthly income. And we're also going to get an idea or estimate kind of what your equity is going to be once that appraisal is completed. Really, the main three criteria we look at for loan approvals is your credit rating, your debt to income, and your equity. Those are really the three big things we're going to look at. Mm-hmm. So we're going to qualify you based off of, pre-qualify you rather, based off of our credit pool. We're going to look at your debt to income, and we're going to estimate how much equity you're going to have. Now, that's just the pre-qual. The next step in the process will be once you're under contract with Tilson and we receive a copy of that contract and the plans and specs and everything that goes along with it, we're going to send you the mortgage application to sign. And we're also going to send you a list of documents that we're going to need to fully process your loan. So depending on your employment, whether it's W-2, pay stubs, possibly tax returns if you're self-employed, or have rental properties, things like that, bank statements. And we're also going to get that all-important appraisal ordered at that time. Okay, so we can't issue an approval letter to yourself or to Tilson until that appraisal is completed. And we have a full loan package returned from you guys with supporting docs. Supporting docs being the income and the assets, things like that. We're going to take that complete loan package and submit it to our underwriter for approval. And the underwriter is basically, we're going to put our loan package together. We think we fully met all the guidelines of the loan that we're getting you qualified for. The underwriter is going to double check all of our work and make sure that they agree that we're meeting all the requirements of that loan program. And they'll typically come back to us with some conditions, whether it's, can you clarify, we need another pay stub, or what was this withdrawal or this deposit on the bank statement? What is that from? Something like that we may come back to you with. And we're going to clear those conditions, and we're going to issue what's called the commitment letter or conditional approval to Tilson for construction. Okay. Basically, what that approval letter indicates is we've fully underwritten the loan package. We have a loan in which we'll be able to close upon completion of the home, assuming our borrower's credit and income stays similar to what it is now, present day. And now Tilson, once they're ready to break ground, can break ground because they have the letter from their lender and they're ready to go. Now, the majority of the documents we use for that construction approval, that commitment letter, are going to expire during construction. And that's when we're going to send you an update letter prior to closing on the completed home. Usually within about 60 days of completion is when we're going to start this update process. This will include a second credit pull, so we have to pull a new credit report because the one we used for the first approval has expired. So we'll re-pull credit. We're going to put together another itemized list of updated pay stubs, bank statements, things like that have expired from the construction approval. We're going to need to update for the permanent. And this is also when we can look at locking in the rate. Okay, so a lot of people ask, Matt, when can I lock in my interest rate on this transaction? We cannot lock it in at construction approval up front. The longest lock term we're going to have is in that 60-day window. So typically our borrowers are locking within 30 to 60 days of completion of the home. For obvious reasons, the closer you are to completion, your builder is going to be able to give you a better projection. So if you're within 30 days, that builder's got a pretty good handle on when he's going to be able to finish that. When you're 60 days out, there's some uncertainty there. There's a lot of things that could happen. Weather, for one. You don't know if it's going to rain for 3 straight weeks, soak your property, and then slow things down. A lot of times that's something that occurs towards the end. It's an unforeseen delay, right? So that's just one example of something that could happen at the end of the process. So we're typically locking in within that 30-day window of completion of the home. People are pretty comfortable doing it at that point, that they feel like they're going to close within that window. The reason why we don't want to lock too soon, if you lock, say, 60 days out and we don't close till day 70 because there was a delay, well, now there's going to be a rate lock extension fee assessed or a relocking fee. There's more fees on the back end. We try to avoid that at all costs by locking within a lock term that we know that you're going to be closing or feel like you're going to be closing.
It's free. Yeah. I mean, that's
there's no cost to lock.
Don't pay
there is a cost if it expires.
Yeah.
So we try to avoid that.
Cool.
There are options too. A lot of people ask me this as well. There are buy down options or discount fee options. So for example, if the par rate or the rate at no cost to you as a consumer is 3%, I could tell you or let you know how much it would cost you out of pocket to buy it down to 2.875, 2.75. There are fees associated with that if you're trying to get a below market rate, but you have that option at closing. We can look at that. I could send you the pricing for things like that. A lot of times people want to take a look at those options as well as just the par rate, which is at no cost.
Instead of paying it over the next 360 payments. Yeah, that's good.
Right.
What else, Don? We got a lot of questions stacked up.
We do. Lisa is asking, Tilson requires 10% down to start building. How does that play into the closing cost down payment?
Yeah, so Tilson does have that 10% equity, just as you mentioned, and just for the sake of round numbers, let's just say your construction cost is $300,000 to build your home with Tilson. You're going to want that pre-construction appraisal come in, the one that's done based off of plans and specs of the home. You're going to want that to come in around $330,000 or so, within that range, to show that you have 10% equity. Because in that instance, or in that example, you're borrowing 90% of the value. Okay, so if your loan amount is 90% of the value, then you've achieved the 10% equity. So you're going to want it to be, actually, you're going to want to appraise at 333 or more, technically, to get 10% equity. But that's kind of the benchmark you're looking at with Tilson. Okay, at the end of construction, if you have room to roll in some closing costs, we can certainly do that for you. So at time of closing, you don't necessarily need that full 10% equity, okay? We can eat into that equity by rolling some of your closing costs in, if you choose to do so, and if you have room within your debt to income ratio to do so.
Okay.
Okay, so as a lender on a conventional loan, I can lend technically up to 95% of the value. Okay, on a build on your lot transaction like this. So I only technically need 5% equity at the end. So let's just say you have 10% equity going into it at construction approval, and then at the end you say, Matt, I want to look at rolling closing costs in. As long as we have at least 5% wiggle room there of equity to do so, I can look at doing that for you.
Okay.
Again, you still have to, we have to make sure you have room within your monthly debt ratio to do that, to increase your loan. But that is an option that you have. And that's one of the nice things about a build on your lot transaction and building on your own properties, because you have that equity. You have some built in. Whereas if you're purchasing a resale or even a builder on a developer's property, you're having to come out of pocket cash, at least 5% plus closing costs on those transactions. So you have the ability to roll in some closing costs in some cases, in most cases, really, on these build on your lots.
Yeah, and Tilson's 10%. Our requirement is because we are building the home with our money. So we want a buffer there that, hey, does the customer have skin in the game? Is there a reason for that they would walk away from this? Financially, we, like Matt said at the beginning, the last thing we want is that home on your land. Like, I don't want that.
Don't want it.
So Tilson wants enough of that of the equity position in there to know that the customer's got equity. There's room there that they.
Yeah, and to be fair, Eric, I mean, if you're trying to qualify for a construction loan, they're typically requiring 20%.
Yeah, they want 20%.
If you're doing a traditional construction loan, they're going to want at least 20. So you're needing even more equity.
Yeah.
Yep. All right. Tanya is asking, I've heard that the magic credit score number that gets you the best interest rate is 740 or more. Is that correct?
Yeah, in general, that's what we consider, A plus borrower. 740 range is kind of a magical number. 700, once you get to 700, you're considered, in my book, an A borrower. When you get to 740 or so, you're A plus, ineligible for the best terms. But 700 really kind of opens up some guidelines on some of the loan programs. Whereas if you're a 680 or 660 credit rating, there may be some more restrictions on what we can do as far as your debt ratio and things like that. Okay. 700, if you can get to that, great. If you can get to 740 plus, excellent. You're in great shape.
Cool.
Great. And then Tanya has another question about VA. She understands that with a Tilson purchase, I have to do a VA refinance and not a VA new home purchase. Since this will be our first time using VA, so the fee would be lower, but at the refinance rate, then the fee is higher. Is that correct, or can we use the VA new purchase loan?
So none of these transactions can be structured as a purchase because you already have a land ownership. Okay, so we can only do a purchase transaction if you were purchasing the house with the land, everything together. But because you already
there's no real estate changing hands.
Yeah, you have land ownership. So what we're essentially doing as a lender is we are refinancing the builder's lien into your permanent note. Okay, so Tilson's going to file a mechanics lien on your property, so they're going to have a lien position on your property. and we have to come in on the back end and refinance that into the permanent note. So these are structured as refinance transactions. They can't be a purchase because you technically already have land ownership. You can't purchase it from yourself. So
that's true in any case when you're building on your lot?
Correct.
Okay.
Correct. Even if you weren't building with Tilson, let's just say you got a construction loan, you're going to do a construction closing up front. In those cases, you're going to get an interim construction loan. And then the lender on the back end, once the house is complete, is going to refinance that interim lien into the permanent note.
Yeah, they're refinancing.
They're always refinance.
Yeah.
Yeah. So there's no way
our construction loan is 0%.
Yes. Yes. Yeah. So there's no, if your lender is setting this up as a purchase transaction, they're doing it incorrectly, to be honest with you.
Okay. That makes sense.
And it will blow up. It's not going to work.
It will.
Okay. And another question about VA. If going with a VA loan, is it required to pay a fee to go to the VA fund? We have been approved for a conventional loan, however, looking at VA as well. So
there is a funding fee that's rolled into your loan with VA. Again, it depends on the amount of times that you've used VA and your VA entitlement and how much equity you have are the two triggers on that VA funding fee. So that is a requirement on all VA loans unless you're exempt from the funding fee because of a disability that you receive from VA. So that's something, again, that we would look at as a lender. We would take an apples to apples comparison. We would look at the VA program for you, and we'd also look at the conventional program, given your qualifications, and see, which one looks better for you, what's more beneficial. So again, that goes back
like she's working with Taylor, so Taylor can probably give her that analysis.
Yes, absolutely. Absolutely she will. So, this goes back to that, VA is not always the best program. Just because you qualify for it. It's a great program, but it's not always the best.
Yeah.
Okay. Great.
Very cool.
We have another question. What is the benefit of paying off land now, or should we hold on to that cash for closing? Around $30,000 owed on land, struggling with the equity versus cash at closing and what to do.
So, I would say for the approval process for construction, until the appraisal's done, you can hold on to that cash. Once that appraisal's done, if we're short on that equity, it may be beneficial to pay that land off. I can't answer that specifically until we know where you are value-wise. If you pay that $30,000, the land balance off, let's just say that you go ahead and do that. You're building equity in your transaction. Okay, so if you've used $30,000 to pay off your land, that's typically going to free up about $30,000 that we could possibly roll in closing costs, things like that. Again, I can't say specifically if that's the better way to go until we have an appraisal done to determine your equity. So,
but either way, the $30,000, whether you pay it down to Tilson up front or whether you pay it on your land, either way, it's going to count towards equity in some way.
Yes. So a lot of times, if you have a land loan on your property and we get the appraisal done, and let's just say based off of the appraisal.
It's already under construction. So apparently we have an appraisal.
So we have an appraisal?
Boy, I hope so if we're under construction.
Good point.
85 still by the goalie.
Yeah, so you could, if you're more comfortable, if we're already under construction, it sounds like we've met equity requirements.
Yeah.
If you feel more comfortable holding on to that cash for now, you can certainly do that. You can
your land payment
down at closing.
Yep.
Whatever if you're wanting to put that money down, eventually on the transaction, you can wait till the end and do that, and basically be the same thing. What I was getting to before was, say we have an appraisal done on the property for construction approval, and we're short on equity, and you have a land balance. If you don't have a land balance, and let's just say we're at a 95% loan to value, Tilson's typically going to require that difference in a deposit before they start construction, so you can get to 10% equity, because that's the benchmark you want to be at. If you have a land loan, people typically, in lieu of writing a check to Tilson, they'll just pay down on their land balance and gain equity that way. So you have some flexibility there if you have a land loan to pay towards that rather than giving an equity deposit. It's the same thing. It works out the same way, and people typically want to pay towards their land in those cases.
Okay, great. Martina is asking if the appraisal comes back lower than we think it should be, can we get a second opinion?
So that's a good question. The only time, as a lender, we have to remain compliant. Okay, so one of the ways that we remain compliant is we have to order our appraisals through a third-party vendor. So there's some separation between the loan originator and the appraiser. Okay, so that's called an appraisal management company. Okay. So we order our appraisals through that appraisal management company. The appraisal comes back in from the licensed appraiser that they, license or bid it out to. And let's just say we don't agree with that value, that we just think it's way undervalued. We as a lender have to send it back to that appraisal management company and have the chief appraiser for that company review that appraisal and basically indicate that it's deficient. It's a bad appraisal. Before we can, as a loan originator, say, okay, well, we want to order a second appraisal then.
Okay.
If that second review comes back and they say no, it looks, these adjustments look okay, the comparables look okay, it's not a deficient appraisal, then we cannot order a second appraisal and remain compliant. We have to stick with that value. Now, that being said, let's just say we get it reviewed and they come back and say this is a completely deficient appraisal. You can order a second appraisal. Okay. Well, if that second appraisal comes in lower, we're stuck with it.
Yeah.
Okay.
It's a more recent appraisal. We cannot revert back to the old one and say, well, no, just kidding. I want to go back to that one because the value actually looked better. So if we get a second appraisal done, we have to stick with that value, even if it comes in lower. There's no more disputing. It's very, very, very rare that we have one reviewed and they say it's completely deficient. It's just, to be honest with you, it's just, it doesn't happen. Then again, as I said before, appraisals can be somewhat subjective, but as a loan originator, we have to rely on a licensed appraiser because that's what they do. That's their profession. That's what they, That
was one of the big rule changes, guys. And when we went through that 06, 07, 08, and all the rules changed, that was a big one. That was one that people were doing, probably had a little bit too much latitude in what was going on.
Yeah, because they were trying to cut down on a lender saying, you can send, back in the day, you could send a request to an appraiser and say, hey, here's the target that we're trying to get to as far as value. You can't do that anymore. No. So they just have to take the information sent to them, do their own comparables, their assessment, and come up with their value. And we have to rely on that. Because we're not licensed appraisers, we're loan originators. There has to be some separation there, and that's some of the protections they put in place.
Yeah, kind of picture like a veil between Matt and the appraiser over here, or even a cloud. Like all Matt can do is send a request up to this cloud and say, I need an appraisal done. And then the cloud, whoever controls the cloud, they will send whatever appraiser they're going to send.
Right.
Matt can't say, hey, I want Joe Bob from XYZ to do the appraisal on this one because he gets me great values. Like that's not allowed.
Right.
Kind of thing. So it's not it's a regulation that we have to comply with.
Okay. All right. Morty is asking, I just left the company I worked at for 7 years to a new employer, but the exact same field. Is that going to be an issue since I've only been with them for about 6 months?
No, that should be okay. The only time where that would, cause a possible issue is if we were trying to, say, for example, you had bonus income from your previous employer every year. You haven't yet established that type of income yet with your new employer just because you've only been there 6 months. So as long as we can qualify you off of your base income, your hourly rate, full time, there shouldn't be an issue when you're changing employers like that. Some fields have a lot of turnover with employment. So if you're in a certain line of work where you're here for 3 months, and then you're here for 5 months, and then you're there for 6 months, that's fine. If that's typical for that line of work. In your case, you've been there for 7 years. You're at the new employer for the last 6 months. You've at minimum established 6 month earning trend with this new employer. So we should be fine in that particular case, as long as, again, we're not trying to use a large amount of bonus income or something that you received from your previous employer.
Okay.
Very good.
Tara had a question about the commitment letter. She's submitted all of her paperwork prior to being approved and just ordered the appraisal. Does she need to resubmit all of her paperwork again to get the commitment, or is she good to go?
No, I mean, we should be fine with that. The appraisal order itself can take, given today's climate, probably 30 to 45 days in some cases even longer.
Yeah.
We have no control over that appraisal process as far as the timing of it. We have to put in our order and then, again, rely on the appraisers to give us accurate completion dates for those reports. But yeah, if you've already submitted your paperwork, for income and assets, assuming it hasn't been 120 days or something of that nature from the time that you submitted that information, then we should be able to use that, those documents. So the income docs and the asset docs, they do have an expiration. Typically, it's about 120 days from your pay stub. So if your pay stub's over 120 days old, it's not going to be valid anymore. Same for your credit report. Our credit reports for new construction like this, they're good for up to 120 days, so 4 months, and then they expire and we have to repull. So yeah, assuming that you've recently submitted that paperwork, whether it's the last 30 or 60 days, we should be fine.
Okay, great.
Okay.
Keaton is asking, I own an investment real estate LLC that buys real estate out of state. How will that affect my debt to income ratio?
So for this type of income, we're going to look at your tax return filings. Okay, so you're going to have whatever your income flows through. It's going to be net income for self-employment, or if you have an entity such as this where you have rental properties and that rental income running through that entity, we're going to look at your tax return filings. Typically for self-employment, it's going to be a 2-year average of what your net income was for those previous 2 years. In some cases, in some programs, we can just utilize the most recent filing rather than a 2-year average. But for self-employment or a real estate investment company where you have rental properties running through it, we're going to be looking at your net income. So after expenses and deductions, we cannot look at gross receipts for this type of income. So we have to factor in expenses and deductions. We can add back in some depreciation or business mileage, things like that. We can add, portions of that back in. But, we're an agency lender, which means that we have to follow Fannie Mae and Freddie Mac guidelines and rules. And that's all, full doc loans. And they require us to use tax return filings, basically what income was submitted to the IRS to qualify you for a mortgage approval.
Yeah, Keaton, that's a federal requirement. That's not
Yes.
That's not something that AmCap or any other lender, like if you're going to play ball and have it marketable on the secondary market for Fannie Mae or Freddie Mac, it must comply with this set of rules and regs, and that's one of them. I think the same person actually says a little while, if he currently W-2 income, it looks like.
Right,
If he goes from W-2, to 1099, that will affect it.
Yeah, so yeah, if you're W-2, if you've been W-2 employee and then you just switch to 1099, there's a couple things. So it depends on, if we're on a conventional program, and let's say you're W-2 and you're switching to 1099, but it's the same industry, same line of work, we're still going to at least need 12 months of filed income on your tax returns for 1099 before we can utilize it for qualifying. So you'd have to, you would have had to have switched over at the beginning of 2021 and file your 2021 tax returns for us to consider that 1099 income for a mortgage approval, because we need 12 months. 1099 is considered self-employed. It's contract employment, but for the purposes of a mortgage approval, they're going to consider it self-employment. And we're going to need a minimum of 12 months of that. If it's in the same line of work that you were in previous, if you completely changed fields, we need 2 years filed. Sorry.
Okay. All right. Martina is asking if it is worth it to buy points on your APR.
So that's a good question. In some cases it is, and in others it's not. So the market, depending on what the market's looking like when we're locking in your rate, will determine if paying those points and fees is worth it. So part of what I do, if you're interested in looking at discount points and fees, is I'll give you a cost breakdown of what the fee is, the fee amount's going to be, how much it's going to save you within your monthly payment, and how long it's going to take for you to recuperate that fee through your savings and your monthly payment. So if it's going to be 7 years before you recuperate that fee, typically you're not going to want to do that. You're going to want to hold on to that extra capital. If it's going to be 4 years or 3.5 years or 2.5, and you're going to be in that house long term, yeah, sometimes that makes sense, to go ahead and pay that additional fee to buy down that rate. So over the 30 years or 20 or 15, however long that note is, you'll be saving long term. But typically, kind of there's a threshold. If it's 6-7 years to recuperate that fee through your monthly payment, a lot of people don't do it in that case, and I wouldn't myself. Because especially right now, rates are so low to begin with that it's incredible. I mean, you're starting off with a 3% or even below 3% without paying any discount. A lot of times it doesn't make sense to buy it down even further and come out of pocket with those charges. But that's something that I break down to the borrowers if they're interested in it, and I can just show them how long it would take for them to recuperate, and they can make their own decision if they feel like that's worth it.
Okay. All right. Lupe is asking, once construction begins on the home, is there any more paperwork done with Matt's group?
Typically, no, not until we're updating for the permanent closing. Okay, so we're going to get the construction approval done. Construction's underway with Tilson, and Tilson will notify us when we're within approximately 60 days or so of completion of the home, and that's when we're going to start the second underwriting process. So there will be a second underwriting towards the end. Okay, so, but during construction, we're not going to be asking for pay stubs or bank statements kind of on a monthly basis or anything like that to update your file. It'll just be a kind of a one-time update at the end of the process once the house is almost completed.
All right. And then Martina's asking, currently she has no restrictions on her loan. She doesn't need to sell her current house. When she gets to closing, if all things are the same, would any of that change?
It shouldn't. If we have you approved without having to sell your current home, then that should not be a requirement at the end unless your income decreased.
Unless your financial situation changes.
Right.
Yes. So, that should not change.
Okay.
And so a lot of times people will ask me also, hey, my construction cost is $400,000. I don't want to finance that full amount because I'm going to sell my house and I want to finance $200,000. So that's wonderful. I have to get you approval for the full contract amount before construction begins, unless you're writing a check to Tilson for that difference before construction starts. So just because I send out an application at a certain loan amount does not mean that that's what you need to finance at the end of it, but that is the amount that I need to get approval for in order for construction to begin.
Okay.
Yeah, any amount difference, guys, between what Matt and his team put on the commitment letter and what Tilson's contract is for has to be paid to Tilson prior to start of construction. So
Correct.
What Matt's saying is go ahead and get approved for that full amount. Even if you plan on putting some money down, you can do that at closing when the house is completed, and you don't have to do that up front. But if what he approves you for is less than what our contract is for, and that's what we see a lot of times, Matt, when we get a non-preferred lender. And it's they're only going to finance 80%, so we're only doing the letter for 80%, and we're like, yeah, well, then we have to have that up front. Like, well, no, they're going to put that at closing, and then we have this whole rigmarole that goes on for a month, and then you have the 5-digit extension, and you can't get a hold of anybody, and yeah, that goes on. So
makes sense. All right. Walter is asking, how is Tilson controlling construction material costs during these unique times where materials have gone up significantly in the last 12 months? Are people sitting on the sidelines to let market prices settle? I recently bought a vacant lot in Llano County and are looking forward to construction sometime in the next year or two.
Clearly a question for Matt Howe. Matt, take it
Yes,
away.
go ahead, Matt.
I'm referring to Eric on this one.
Great question. Yeah, no, the answer is it's kind of like controlling a fire hose that you're holding at the far end, not the end that's actually spraying the water. So it's kind of over the place. But no, the reality is, yeah, I mean, things are changing, right? But look, we started in the Great Depression. We were a company before there was even a World War II. Okay, we've seen World War II, Korea, Vietnam. We put a man on the moon, all this great stuff. The oil embargo of the 70s, real estate crash of the 80s, .com bubble, September 11th. Matt was with us through the recession. Like, we've seen a lot of pretty crazy stuff. Okay, I'm not going to say we've seen it all because I've not watched the trailer for 2022 yet, so I don't want to know. But what I will say is that, you know, obviously prices went up, they go up. You know, what are you going to do? Copper, steel, labor. There's massive labor shortages, so they're all clamoring for more money, and they're getting it. You know, and not just framers. I'm talking painters, trim carpenters, electricians. Like, they're in high demand, and they're trying to find people too, just like we are, just like probably whoever you work for, Walter, are. And it's very difficult to find skilled people right now, and so you're having to pay more to get them, which means you have to charge more to lend your services out. And so, you know, we're controlling costs everywhere we can, obviously, but at the end of the day, a 2x4 costs what a 2x4 costs, right? A sheet of plywood costs what it costs. But I don't, as far as, you know, sitting on the sidelines, let's say, and watch the prices settle, a price to build a new home is not going to go down. I can tell you that. Like, we've been doing this long enough to know that over time, prices go up. It's not like gas at a gas pump. It's not going to fluctuate wildly based on what's happening out there. You have crazy things that happen in short bursts, which is kind of what you saw 2020, 2021. But if you look at the overall trend line over even just a 5-year period of new home prices, they're going up. So what you're hedging against, and this is where Matt can get involved, is right now, if you were watching earlier, he can loan you money at like 2.95% or 3%. Okay, now, let's say home prices are let's say they stay the same. They're not, but let's pretend that they are. If rates go up even 1%, Matt, what does that change? I mean,
it changes your borrowing power, right? So you may not be able to qualify for the same amount of, you know, loan amount if there's an interest rate increase because your debt ratio increases.
Yeah. So we can say, you know, basically a house price would have to, I did this math a while back, but the price of a new home would have to go down about, if interest rates just go up 1%, from let's say 3 to 4, a house price would have to go down almost $60,000 to make the payment the same. Does that make sense to folks? Like, it's a big, significant difference. On a $390,000 house, that house would have to drop all the way down to $330,000. I don't think they're going to go down at all, but let's say I'm even wrong. If they're going to go down, they are not going to go down $60,000. That's not happening.
Yeah.
So, Walter, I would say, sitting on the sidelines, like, I don't think interest rates can go any lower. Maybe I'm wrong. I said that at 6% too, so clearly I was wrong. But I don't see them going a whole lot lower than 2.95%. So if you're betting on anything to go up, I would bet interest rates will eventually go up. Not this year, probably not next year even. I don't know. But eventually, over the next 5-7 years, it's going to happen.
Yeah. If you're in a position to build now, I would not wait. I would get started. All right. We get a question. I own the land outright. So how does that work in terms of financing the home build? Is there a minimum credit score, and is there a required down payment to start?
So there is a minimum credit score requirement on this particular transaction, and that's a 640. Okay, so if we're short of a 640 on your credit rating, and that's your middle qualifying score, so we pull a tri-merge report, which is from all 3 bureaus, and we're going to qualify you off of your middle rating. Okay, so if your middle rating is a 640 or higher, then you've met the minimum credit requirements to build with Tilson. If it's below that rating, then again, that's something that I and my team can help you with as far as what to work on to reach that credit goal of a 640 or higher. we can run some simulators to help kind of get a game plan on that for you. So 640 is the benchmark kind of to proceed. And down payment, again, that goes back to how much your land or your property is valued for, based off of that appraisal that's completed. If your loan amount is only 90% of the value, then you reach that 10% equity that Tilson requires. If you're short on that equity, then there may be a down payment in order to reach or to start construction. So that just depends on that appraisal.
Yeah, but the value of your property, whatever it comes back at, Kesha, is part of that down payment. That you would not have to put all the money down, just whatever separates you from that 10%.
Correct.
Okay. All right. And then Hugh has a math problem for us. Land paid and value around $300,000. Building cost estimate $600,000. Do we need to put any cash down at closing to meet the 20% requirement for no PMI?
And that's, so you're saying it appraised for $900,000?
So I've done the math. If you want to put it up, Dawn, we could do that.
Yeah. Right. So you have more than 20%. So in this particular case, I mean, your loan amount is over the conventional loan limit. So you're at $600,000 for the total combined loan. So we're most likely going to be splitting that into a first and second lien, which means we'll put the conventional loan limit on the first lien, which is $548,250.
Oh, so I knew it was close.
And then we'll put that remaining balance on the second lien to cover the entire balance there. And in those cases, you're not going to have any PMI, okay? Because that first lien amount is going to be less than 80% loan to value, and then the remaining balance will be on that second lien. Now, the second lien is going to have a higher interest rate than the first lien, okay?
Okay.
Because second lien companies charge a higher premium on those rates. So whereas, say we're at 3% on our first lien amount, which is the bulk of the loan, the $548,250, the second lien company is probably going to charge around 5.25%, 5.5%. So they're going to have a higher rate on that second lien balance. We do not set that rate. It has nothing to do with AmCap. That's a completely separate market.
It makes sense. I mean, you're not making as much. It's not as high volume, so you got to charge a little more money because you're only getting a $50,000 loan. I mean, it's like a car loan.
And it's a little riskier because you're in second position. So
exactly,
if anything were to happen.
Yep, you're in second lien position, so it's a riskier proposition for that lien holder because if anything were to happen, they pay off the first lien holder first.
Yeah. This guy's getting paid off first.
Yeah. So an alternative to going that route would be a jumbo loan or a non-conforming loan is what we call it. But if you go that route, the full loan balance, the $600,000 would be on the jumbo loan, and that would be subject to a higher rate, the full balance. Now it's not going to be 5.5, but it's not going to be 3. And then you'll be paying interest off of a $600,000 principal balance at a higher rate for the life of the loan.
And that's because you're getting out of those Fannie Mae guidelines, right? You're out of bounds on.
I'm sorry, say that again, Eric.
When you're over the conventional loan limit, is it you're no longer dealing with a Fannie Mae backed?
Correct.
Security.
Yeah. So if you're over that $548,250, and that's specific to the state of Texas. Other states have different benchmarks, but the state of Texas right now is $548,250. Anything above that loan amount is non-conforming, which means it's not compliant with Fannie Mae or Freddie Mac. So you don't get those rates for those programs.
So you're going to a different portfolio, someone else in your portfolio, a different investor.
Correct.
It's no longer somebody that can be sold on the secondary market.
Correct. Yes. So it would be a lot of banks just portfolio those loans. So basically that means that they just keep them in-house, service them for 30 years or 20 years, however long they are. And they don't look to sell them on the secondary market to other banks or anything like that. So we don't really do jumbo loans right now. We are pretty much always splitting them into first and second liens rather than looking at a jumbo loan product.
Okay.
Cool. Hope that helps you. I did a lot of work on the whiteboard to make it, so I really hope it does.
All right. Morty is asking, Tilson requires 10% equity. Do you as a lender have an option to offer a conventional loan without PMI, considering 20% is usually required?
So if you have, less than 20% equity, there's going to be PMI required unless we split it into a first and second lien, where we would put 80% of the balance on that first lien and then the remaining balance on that second lien. Typically, people don't want to go that route, again, because that second lien is going to have a higher rate on it. And the PMI, although people just hate it, they don't want to pay that, it's not for the life of the loan. Okay, it's eventually going to fall off. So typically people will just opt to pay that PMI for a few years until it falls off, rather than splitting it into a first and second lien where 80% is on the first balance, that remaining 10% is on the second balance, and then you have 10% equity. So that's called an 80-10-10. That's where you can eliminate PMI without having 20% equity, but again, you have to pay the penalty of having a second lien with a higher interest rate. And
that's on conventional.
That's only on a conventional loan.
FHA.
Yes. FHA, you're going to have mortgage insurance regardless of your equity position.
That's right.
You can put 30% down. Doesn't matter. You're going to have mortgage insurance.
Sure.
Okay.
So yeah, it's different from program to program.
Okay. Ashton is asking if we show a loss in 2020 due to COVID, but back to normal pay for 2021, can 2019 be used to show income as well?
So I'm assuming he's talking about self-employment. I'm not sure if that's what he's referring to. I'm going to answer this as if I'm assuming self-employment tax returns. So typically we use an average, a 2-year average, but let's just say we filed 20. So right now we're looking at 2019 returns and 2020 returns because 2021 is not yet filed.
It's not over yet.
It's not over yet. So
it feels like it should be. But
it's a long year. So let's just say 2019 you earned $100,000 a year, and then it went down to $75,000 in 2020. In this case, we're not going to take a 24-month average because there was a decrease. We have to use the most recent filing. If it were vice versa, let's just say in 2019 you had $75,000, and in 2020 you're now at $100,000. In that case, it was increasing. So now we're going to average these two together. So 2019 is going to bring the average down a little bit. So we have to take worst case scenario. That's what is required. So if you're a W-2 employee, say your 2019 was good, your 2020 was down, and now 2021 is looking good again, and that's a little bit different, because we could take a look at your hourly, what your hourly pay is, how many hours you've been working, so on and so forth, and it'd be easier to use your 2021 income and justify that if you were a W-2 employee, rather than a self-employed. They just make it harder for self-employed borrowers to qualify, just because the guidelines are very black and white and very strict when it comes to kind of utilizing tax returns. So, if this borrower is self-employed, we would just right now we'd be looking at his 2020 returns. If they're a decrease from 2019, that's what we would have to utilize right now.
Okay. All right. Therese is asking, she's using her VA loan and with a disabled vet. On her commitment letter, there was closing fee. Will that be rolled into the loan?
A closing fee? Maybe she's
maybe it's closing cost.
I'm not sure. So if it's a funding fee, if the veteran is disabled, then there wouldn't be a funding fee on the loan. If you want to. Who's this for? Teresa Lathan. I'll have to mark this one down and check in our system to see what.
We'll check it out. That's assuming that they're using AmCap, Matt. Which we have people from like Australia and Germany and stuff that watch that and you're maybe a little rusty on the lending requirements in the European Union. Not sure. Yeah, she says close to law.
Right. So it's. I can't answer the question. Will that be rolled into the loan?
Oh, she's saying it is her closing cost.
Closing costs. Okay.
Listed.
So if you have, depends on how much equity you have, and what your debt to income ratio is. We can look, possibly roll in your closing costs on a VA loan, conventional or FHA. It just really depends on how much equity you have. Is there room within your debt ratio? So basically, if we increase your loan amount, which will increase your monthly payment, is that going to put you over a threshold within your debt to income ratio? So it's a case-by-case basis. But yeah, that's something that should be an option to roll in at least a portion of it, unless you're on a VA loan. If you're at 100% loan to value, because you can go up to that technically on a VA loan, then there's no room to roll it in.
Okay.
But if you're at a 95% loan to value, we should have some room there.
Okay. All right. Karen is asking, I own the land, however, still owe $58,000 on a house. Can the $58,000 be added into my financing loan for Tilson? And would I still be required to put down 10% equity?
So you're asking if your current mortgage balance on your current home can be added into this?
Let's answer it two ways. Let's answer it that way, and then the other one would be like maybe they owe on a mobile home that's on the land.
Mm-hmm.
Okay. Well, let's look at the first scenario. So if you owe $58,000 on your current home, that's not included as collateral. It's not our collateral property that you're building with Tilson, then that cannot be rolled in. That has to stay separate. You'll just continue to pay on that mortgage note as you would. If it's not part of our collateral property, so let's just say our collateral property is 1 acre. If you have a land loan on that 1 acre, it will be rolled into our transaction. If you own
Karen is saying it is a Jim Walter home.
So yeah, that's going to be something completely separate. Now, Eric, are you reading this that he's got that house on our subject property? I'm not familiar with Jim Walter.
So Jim Walter, I'm now dating myself officially.
Oh, they were built on your lot builder in 2007. They went bye-bye. They didn't make it.
So the Mid-State Mortgage was who held the loans, and they were in-house financing. And so they did not follow conventional. They didn't do Fannie Mae guidelines or that kind of stuff. True in-house financing, where you could finish, get them into unfinished homes, semi-finished shell. And so, they didn't always do a lien on the land and tie the land up, but it's basically, I don't know if she's wanting to demolish it, keep it, because you can't have 2 single-family residences on one piece of collateral property, right? Is that still the case?
Yeah, and if there's a mortgage note that is a lien on the property, then it either needs to be rolled into our loan, and we can only roll in land loans into our transaction. If it is for an improvement for a house, that's going to have to be paid off or released. So yeah, we wouldn't be able to roll an existing mobile home lien.
She wanted to demolish.
She wants to demolish it.
Okay.
So Karen, before you do anything, I'm sorry, Matt, go ahead.
No, go ahead. Yeah, I think you're down the right track here.
Yeah. You need to reach out to the lender. And I don't know if you're still with Mid-State Mortgage or if you've refinanced since then, but if that lender is an investor and they have loaned money based on on real property plus the improvements. If you go to demolish that home, that changes the ball game, and they could potentially call that note due immediately. So don't do anything with it until you check with your current lender. Be totally transparent with them. Tell them exactly what you're wanting to do, and find out what their terms would be like to either refinance it, do a cash out, do a HELOC. I don't know what you could do potentially, but I know if you owe money on it, I would not go straight to demolishing it, because they could call the note due immediately.
Absolutely, that's exactly what I was going to say. Yeah, so it's that lender they lended that money based off of, or lent that money based off of that collateral property, which at the time was an improvement. So if you're knocking that improvement down and changing what their collateral is, they may have a problem with that. So definitely contact that lender first.
Okay. Evelyn is asking if you offer a bank statement product for self-employed borrowers.
We currently do not.
Okay.
So we're going to be right now just following agency guidelines. So everything's full doc. I don't know if, in general, Eric, are you guys wanting to
We haven't seen a lot.
something like
Well,
that?
it's a great question. No, and pretty much every lender that our customers are going with, they're in the same boat. So ever since 2007, 2008, when all the rules changed, Evelyn, when Matt says an industry term like full doc, what that stands for is full documentation. In other words, all the cards are on the table. Okay, this is my last 2 years of bank statements, my last 2 years of W-2s, or in your case, last 2 years of tax returns. Here's everything. And that's a Fannie Mae and Freddie Mac, the federally backed loan originators, lenders. They want to see everything, to be compliant, which Matt said a while ago as well. So these agencies, these mortgage brokers, which they have to comply with all of those guidelines. If it's on Fannie Mae's checklist, Matt is obligated to check that box. And there aren't currently any products, is that the right word, Matt?
Mm-hmm. Yep.
That can get a Fannie Mae backed loan that do what you refer to as stated income, or no documentation, or partial documentation. Now that doesn't mean that you can't get. There's credit unions that will do loans. There's banks sometimes that will do those type of loans. There probably are investors that will do that. Hard money lender is really the wrong phrase for it, but it's not dissimilar from that. But there's not a federally backed product, which is what everybody wants their mortgages they lend money out on to be backed, because it's insurance for the mortgage company, right?
Yeah.
If you default, the borrower defaults, they're going to get made whole by the federal government. If and only if the loan complies with the guidelines. Is that simply put?
Yes, yeah, and if you do find a lender that's doing a bank statement program, and they're out there, don't expect to get a rate that you would on a Fannie Mae loan. So if we're at 3%, a bank statement product, something like that, that's outside the box, is probably going to be 6.5, 7.
Oh wow!
The rates are going to be much higher. You might be shocked by that. But that's because it's a riskier product, and they're going to
be an ARM. It'll be like it'll be a 30-year amortization, but a 5-year balloon, something like that.
It'll have some funky terms tied to it, most likely.
But we've seen those. But Matt's right. It's going to be a much higher rate. But for some business owner, like if you know that you're going to sell your company in 3 years, and you've got a offer letter, and you're just staying on because you're obligated by those terms, and you're going to get a big windfall at the end of 3 years, it might make sense. Those are that very small percentage of human beings is who the adjustable rate mortgage was designed for, or the balloon was designed for, not the masses.
Right.
Anyway, great question though, Evelyn. Great question.
All right. If my plan is to sell the current home right after closing and put those proceeds on new loan after closing, is there a way to reduce monthly note without having to turn around and refinance and pay refinance fees?
Yes. It's called a recast. So you can do a one-time principal reduction shortly after closing for what's called a recast. And they will recalculate your payment based off of the lower principal and interests after that lump sum payment. There is a fee to do that. It's usually a few $100s rather than, a couple thousand, which would, a typical refi is going to be a couple $1,000s at least. But there is a recast option so if it's in place specifically for that. If you sold some real estate just after closing, you want to apply that towards your principal and recalculate your payment off the lower principal, you have a recast option. Just let us know as loan originators that that's what you're planning on doing, so we can make sure it goes to an investor that allows for that.
Okay, perfect.
Cool.
All right.
All right, you guys start putting your last questions in. I know we're up against the time. We already kept Matt 25 minutes longer than we said. He's doing great. Keep the questions coming, but we will have to let him go eventually. He has borrowers to call and whatnot, and loans to close. But put him in, and we'll keep it long. And if you have to go, Matt, let us know, and we'll answer all these questions.
We'll get our much less educated opinion.
I'm okay. Hey, I haven't looked at my emails yet. I'm scared to.
Okay. All right. Go ahead, Don. I'm sorry.
All right. Laurie is asking, are you able to finance asphalt driveway into the mortgage?
So if there's some allowances built into your contract with Tilson, so an example would be a well allowance or septic or driveway sometimes, those can be rolled into our loan, but it has to be done through the builder. So you have to go do a change order through the builder to add those costs or those expenses to our lien, to Tilson's lien specifically, for us to be able to roll that in and pay that off with our note.
Okay.
But yeah, it has to be done through the builder in order for us to do it. So you can't take out a loan to put in a driveway and then ask us to roll that loan in. We can't do that.
Right, and that lien needs to be changed or amended. You have to do that with us before the work is done.
Yes, very important.
You can't do the driveway, then you hand us a receipt or hand Matt a receipt and say, "Hey, add this in." Can't do that. It must be done beforehand. So it's a great question. Thanks for asking, Laurie.
Yep. Which actually, I think that applies to Rosemary's question, saying she needs a call from Tilson, found out she can put her septic into the loan, and Taylor made it happen. Curious if there's going to be a fee to do that, and set to install septic on the 14th. So
Laurie, we've already reached out to Laurie, Rosemary, because I can do things when Matt's hosting the show.
And I'll stop writing down.
And Laurie has already responded and said, yes, thank you. I have her on my to-do list. So be expecting a call from Miss Laurie Ramirez. Y'all check that up today.
All right. Perfect. All right. Sorry to be off the financing subject, but is a silt fence installed by Tilson and required by the neighborhood? And is that cost covered by Tilson?
So if we have included what we refer to as a subdivision type of subdivision fee in the original contract amount, then yes, it is covered. But if there wasn't any type of what we refer to as CSWO or subdivision compliance cost, if there wasn't any of that included, then the silt fencing is not going to be included in that. So great question.
Okay. Perfect. Liz is asking, do we have to include home insurance and taxes to our monthly payment, or can we pay those directly when they're due? She's going to pay 20% down at closing.
So as long as she's on a conventional loan and she's putting 20% down, she will have the option to what we call waive escrow, which is what she's talking about. So if you waive escrow, all you're paying on a monthly basis throughout your mortgage payment is your principal and interest. And then you take care of your property taxes and homeowners insurance when those bills come due. But you specifically need to be on a conventional loan with 20%.
Okay, perfect. Neil is asking, we are purchasing 2 lots, but the house will be built on 1 lot. Can the appraisal use both lots or just the lot that the home will be on?
Well, that depends on if you want to tie the other lot up into this lien. Okay, so let's just say we're going to use both lots as our collateral and include that within our appraisal. Then our mortgage lien and Tilson's lien is going to be attached to both lots. So let's say we close on the completed home, and then a year later you want to sell off lot 2, you can do it because it's part of our mortgage lien. If you want to keep them separate and just use 1 lot and then do whatever you want with that other lot, that's fine. But we cannot use that as collateral for our transaction unless our mortgage lien is attached to it. So if you have plans with that other vacant lot that you want to do later on, I would suggest not tying it up in our transaction.
Okay. Makes sense.
Great question, Neil.
Yeah.
Thanks for watching again.
Yeah. Teresa's asking if there's a maximum time frame to do that recast.
That's a good question. I don't know. I'm going to assume it's about 90 days, but I don't know specifically the answer to that question.
Stump the 20-year veteran.
Sorry.
You promised him no one was going to ask him questions he didn't know. He's never coming back now.
I know.
But he can find out pretty quick.
Yes.
Okay. Well, folks, I know that. Thank you guys for watching. Thank you for asking all these questions. We know when they go this long that y'all have gotten some value out of it because you keep asking questions. That's a long time to hang in there. Again, we know how important the financial part of it is. So, Matt, thank you for not only what you did today, but for helping these customers make this dream home thing a reality. And again, working with Tilson, working with you guys, they're going to be in safe hands, knowing that we know the process, our process, everything there is to know about build on your land. So grateful for that. And of course, while talking and you're going to sign off, the last question just rolled in because that's what happened.
Yes. Yeah. Lupe is asking, if you pay out of pocket for a septic system, is there any type of incentive for that?
No, Lupe, you're not financing your septic for 30 years. So there's some incentive, right? I mean, any dollar amount that you put into that mortgage, you're paying interest on that for 30 years or until you pay it off. So, that it's if you can pay for it out of pocket, if you don't need those funds to do other things with, I recommend doing that. Don't finance it, but you could make the argument also at 2.9 something percent. What's the harm? If the appraisal will support it and it will fit in there, and then you could maybe do that. But that's, we probably didn't put enough emphasis on that today, but the appraisal really drives the bus on a lot of these questions about equity. It's not necessarily what you put in dollar wise. It's what is that appraisal going to come back at? So anyway, thank you, Matt, for doing this. Thanks for loaning us this time. And we really appreciate it. Dawn, thank you as always for doing this. Thank you all for watching. And we hope you got something very useful. We have all of our media. Matt, how can people get a hold of you if they want to make an application?
Sure. So my email address is mhowe@myamcap.com. So it's MHOWE at myamcap.com. You can reach me via telephone 281-953-2541. So either way works for us. It may take me an hour or two to get back to you, depending on how long
or an hour and a half.
How much volume I'm working on, or if I'm in a seminar. But I will get back with you. That's one of the nice things about working with AmCap is there's the accessibility. So you can get a hold of myself or someone from my team.
Yep, and they've got a really slick mortgage calculator on their website as well, because I play with it often. I use it for calculating people's payments.
Yep.
So they're there. He can help you anywhere, on a refinance, on a purchase, or obviously building a home on your land with us. We'd love to help you out. Oh, Pam, we got an abbreviation for Waxahachie. It's just the Hatchie.
The Hatchie.
I'm going to use that. Then I won't have to debate with people how to pronounce it. So.
Anyway, of course, obviously we have a Tilson website. You guys there's a lot of content there. A lot of tools that Dawn and her team have put together on there. We've got our Facebook page, YouTube channel with tons and tons of content that you guys can just binge on. That's what it's there for. It's not there for us. It's there for y'all. And obviously we have 11 locations throughout the state of Texas, open 7 days a week. We just poured concrete on a 12th one this morning.
We did.
Yep. So that's happening. So anyway, grateful for you guys, and we genuinely soon to hope you make you part of the Tilson family. We'll see y'all later.
Bye, guys.
Bye, everybody.